Hello students, this is Companies Lecture 4. These are my contact details. Email me if you have questions. I will be checking my emails even during the recess period in the first week of October. These are the learning outcomes that we've covered in lectures 1 to 3 on companies. We've done an overview of the different types of business entities. We've done an introduction to companies. We've done accounting entries for the issue of shares and also the conversion of par value shares. That means shares from par value to no par value. We've done the note for share capital, the disclosure of equity in the statement of financial position, and the disclosure of share capital in the statement of changes in equity. We've done the accounting for corporate tax, transfers to and from other components of equity, like asset replacement reserve, and we've also calculated and accounted for dividends on different classes of shares. You will see in the question that I'm going to do today, a lot of the components that have been discussed in previous lectures are going to be incorporated when I do question 8.8. So what we've already covered in the textbook is chapter 8, pages 213 to 230. And there you can see all the questions that we've already done the work on that you'll be able to do. So it's 8.1 to 8.6 and 8.9 to 8.11. So the learning outcomes for this lecture are we're going to account for revaluation reserves. We're going to prepare the statement of changes in equity, showing the effect of appropriations that we've already discussed. We are going to be working with chapter 8, pages 231 to 236. And to end the lecture, I'm going to go through example question 8.8 from A to C, which will bring together what we've done in companies so far. So let's talk about revaluation reserves. A revaluation reserve in FRK 121, we are only going to do it for land. And land often is something that increases in value over time. So if the business was going to put the correct value for land onto their statement of financial position, it means they would have to revalue their land. So it is possible that you can revalue any non-current assets, but we'll only deal with the revaluation of land. And if you do revaluate land, you will debit land and you will credit a revaluation reserve. This revaluation reserve is part of equity, and we will include it under the equity section of the statement of financial position. On the statement of profit and loss, at the bottom of the statement of profit and loss, you're going to see that later on in the lecture, there's going to be a section called Other Comprehensive Income, Gain for the current year, and the revaluation reserve will be included there. And then it will form part of equity, the accumulated reserves at the end of the year in the statement of financial position. But you'll see this in question 8.8. Let's try now example 8.7 in your book, which is going to then pull together all the transactions that you can expect in your retained earnings account, but also what we've discussed with revaluations and transfer to asset replacement reserves. So here we have the year ended December 2013, and we have a balance on the 1st of January. They tell us the accounting profit, which is the taxable income. Now, in accounting 1-to-1, your accounting profit and taxable income will always be the same, and the amount is 107,144. So in other words, we need to pay tax on that amount. The tax rate is always 28% unless you're told otherwise. 5,000 is going to be transferred to the asset replacement reserve at year end in anticipation of scrapping of a few of the company's assets. In other words, we're going to need to replace the assets in future in 2015. There was 5,000, the same amount was transferred during 2012, but we're working here with 2013, and 5,000 is transferred from retained earnings to asset replacement reserve in 2013. During the year, the company revalued land by 10,000 more than the carrying amount, and the company applies the revaluation model. And in example 8.5, there are dividends that were declared, and we're going to account for those dividends in the retained earnings account. So the first amount that's going to go into the retained earnings account on the credit side is the balance of 43,600. Retained earnings will always have a credit balance unless you've got retained losses or accumulated losses. Then those will have a debit balance. But everything in equity normally has a credit balance. Remember, equity is the difference between assets and liabilities. It's what the business is worth to the owners. So the earnings that have been retained in the business actually belong to the owners and has increased their investment in the business. So we put the opening balance and retained earnings in first, and now let's look at the accounting profit that needs to go into retained earnings. They give us an accounting profit for the year, which is the same as the taxable income of 107,144. This is the accounting profit before tax. So the amount of taxation of 28% still needs to be deducted. So the profit after tax is 77,144. This would have been the amount then that's in your profit and loss account. So the profit and loss account would have been debited, and we credit retained earnings with the profit after tax. So if we carry on looking at the information, the next bit of information is that 5,000 Rand was transferred to the asset replacement reserve during the year. So in our retained earnings account, we're going to debit retained earnings, and we will credit asset replacement reserve with 5,000. So this is an appropriation of earnings. We're setting aside part of the earnings into a separate reserve, and that reserve we don't normally pay dividends out of it. Then they tell us that there was a revaluation of land of 10,000. Now this revaluation of land of 10,000 is actually not going to affect retained earnings. We're going to debit land with 10,000 and credit revaluation reserve. The revaluation reserve is a separate reserve account from retained earnings. It gets shown at the bottom of the statement of profit and loss, and it has its own column on the statement of changes in equity. So this amount of 10,000 will not go into our retained earnings account. Dividends declared will, however, the dividends declared, if you go back to example 8.5, you'll see the dividends, and there are dividends in example 8.5 of 800 for ordinary shares and 187.50, which I've rounded to 188 for preference shares. So those dividend amounts end up in the retained earnings account. These are also appropriations of profit, and we will credit shareholders for dividends. Then we can balance the retained earnings account. So the closing balance at the end of the year, these are then earnings retained in the business, which are still available to be distributed as dividends to shareholders. We're now going to look at question 8.8. This is quite a detailed question, and I'm going to go through the whole question with you, parts A to C, so that you can see how to put together the financial statements for a company. So we have Orion Limited, which is a trading entity that's been in operation for 5 years, and the following balances were taken on the 28th of February 2003 after year-end adjustments, except there are a few year-end adjustments which we're going to do, so it's after those were recorded. I'm not going to read through the whole of the trial balance, but you will see as we go along, we will pick up the amounts from the trial balance that we're going to be using in the question. Just something to notice in the trial balance, always you need to be thinking about whether we've got periodic or perpetual system for inventories, and here we see sales and cost of sales. So it seems like this is a perpetual system, which means this inventory amount will be the inventory amount at the end of the year. This retained earnings amount must be the retained earnings at the beginning of the year, because all of the transactions, that's the profit for the year, the dividends and so on, are closing entries that get made, and the closing entries haven't been done yet. We've only done year-end adjustments, we haven't done closing entries. So the retained earnings balance is at the beginning of the year. The accumulated depreciation balances are also at the end of the year. We can actually see that there is a depreciation expense for the year that's already been created. So this accumulated depreciation are balances at the end of the year. So it's just good to have a look through these trial balance amounts to check which amounts belong to the end of the year and which amounts were the beginning of the year. They're all the end of the year, except for retained earnings, is what we've now discovered. Now let's look at the required part of the question. They've asked us first to enter information in numbers 6 and 7. This refers to additional information that we're still going to be looking at. And we're going to put that information into the general journal. That means we're going to do journal entries. Then we're going to do the following accounts. These are general ledger accounts for the year ended 28th of February 2003. The profit and loss, retained earnings, income tax expense, and current tax payable accounts. Then we're going to prepare the financial statements, also for the year ended 28th of February 2003. The statement of profit or loss and other comprehensive income. Expenses classified according to function. Okay, now when you prepare financial statements for a company, the statement of profit or loss is always going to have an other comprehensive income section, and in the other comprehensive income section we are going to, in Accounting 1-1, only record any revaluation reserve on land. There are a number of ways of classifying expenses on the statement of profit or loss. The way that we're going to do it in Accounting 1-1 is expenses are going to be classified by function. So we will always have cost of sales and admin expenses and distribution expenses. There is another way where you classify expenses by nature, but we are not going to teach that to you this year. So this is standard wording, and I'll show you what the statement of profit and loss looks like with other comprehensive income and expenses classified by function. We're also going to look at the statement of changes in equity and the statement of financial position. Part D of the question we will do in the next lecture. Okay, so if we go back, this is the original information that was given to us that I've already explained. What we're looking at here are trial balance amounts at the end of the year, except for a few entries which still need to be made according to the notes that we now need to read. So this is the following information. It's item 6 and item 7 that they've told us we need to do journal entries for. There will be journal entries required for the others when we do the books of the business, but they're not asking us in this question to prepare the journal entries. So they're telling us the preference shares are redeemable. Immediately you see redeemable, it means those preference shares are a liability because we have a definite date that we're going to pay them back on the 28th of February 2008, which is in 5 years' time. So the redeemable preference shares will be a long-term liability, and they have a fixed annual dividend of 20 cents per share. So for every share that you own, you will get 20 cents as a dividend every year. It's a fixed annual dividend. On the 30th of November 2002, that was during this year, 50,000 ordinary shares were issued at R2.50 each. Now, if you remember on the trial balance that we saw, and you will see it again, there is a final amount for ordinary share capital. They are telling us here that this issue that happened on the 30th of November has been recorded correctly. So when we look at the figures at the 28th of February 2003, this amount has already been recorded. The income tax must be provided for the current year at a rate of 28%, so we're going to have to do that. We can assume the accounting profit before tax is the same as taxable income. That will be standard when we do Accounting 1-1. And they're also telling us we've already paid 60,000 of provisional tax. tax has been paid in advance for the year. Then they're telling us on the 20th of February, that's just before the end of the year, the dividend on preference shares, that's this dividend here of 20 cents, as well as the dividend of 18 cents on ordinary shares, was declared on all issued ordinary shares registered on the 28th of February. So on the 20th of February, the declaration was made. Remember, you can't issue a dividend to ordinary shareholders without paying the dividend to the preference shareholders first. So the preference shareholders will get their dividend, and the ordinary shareholders that are registered on the 28th of February will all get a dividend of 18 cents per share. There is a loan, and we'll see that that loan is a mortgage bond, and they're telling us it's repayable in 4 equal installments. The first repayment is on the 30th of June 2003. Our year end is 28th of February 2003, so we are going to have to take out this portion of the loan and show it as the current portion of long-term liabilities, because that date is within the next 12 months after the year end. They're telling us land is valued at $570,000. So we're going to see on the trial balance the land is at a lower amount, and there's a revaluation we need to record. And we also need to increase the asset replacement reserve by $15,000. For these last two, they require us to do journal entries. So we'll do those first. These are the journal entries. The first journal entry for land is debit land with 50,000, credit revaluation reserve. In our books, in our trial balance, if you go back and look at it, the trial balance shows an amount for land of 520,000, and this is the revalued amount. So if you take 570 minus 520, it means the land, which is an asset, must be increased in value by 50,000. That's why we debit land. We're going to credit revaluation reserve then with 50,000. This is going to show on the statement of profit and loss as other comprehensive income, and then in the equity section of our statement of financial position, we will show this together with any other reserves. Then they've also told us the asset replacement reserve must increase by 15,000. That means we must take 15,000 out of retained earnings and credit that 15,000 to the asset replacement reserve. Like with the revaluation reserve, this asset replacement reserve is going to be shown on the statement of financial position as other reserves of the company. So those are the two journal entries we need to do. So we've got a journal entry here where we've created two reserves for the entity at the end of the year. So the rest of we now need to do general ledger accounts. So the first amount we need to put into the profit and loss account is the gross profit. They haven't asked us in this question to do the gross profit account, or rather the trading account. But if you calculate the difference between sales and cost of sales in this question, you will get the gross profit. These amounts come straight from the trial balance. So in your trading account, there would have been a credit balance of 88,500, and that 88,500 would then get cleared out of the trading account, debit the trading account, and credit the profit and loss account. So the first entry in the profit and loss account is coming from the trading account, and it is the gross profit for the year. So here are the amounts on the trial balance. There's the 2348, and there's the 146,500. We're also now going to put the other income amounts in, the 5,000 for interest income and the 36,000 for rental income. So in our profit and loss account, we've now got the amount for gross profit, which is sales minus cost of sales, interest income and rent income. So in our profit and loss account, this is the account where we're now taking all the income and expenses, putting them then into this account. The balance on this account is going to end up going to retained earnings, which is part of equity. So remember, all of your income and expense accounts have to be closed at the end of the year, so they start every year with a nil balance, and every year then you work out the new income and expenses for that year. Now we're going to look at expenses. So in this question we've got interest expense of 18,000, and then we've got distribution costs, admin costs, credit losses, depreciation and sundry expenses. All of these expenses need to go to the debit side of the profit and loss account. One thing that we need to remember, in this question we said because the preference shares are redeemable, that means they are like a liability. So that means this dividend of 20 cents per share is actually going to be considered to be interest, because this is a liability, the dividend is fixed, we're going to pay it every year, so this interest expense has to be accounted for. So they've told us on the 20th of February the dividend on the preference shares was declared. And the following information must still be taken into account. It means this hasn't been taken into account. So we're going to need to calculate the amount of this dividend on preference shares. We're not going to call it a dividend, we're going to call it interest, because the redeemable preference shares are like a loan or a liability. So when we put all of these expenses onto the profit and loss account, we are clearing the expense account, so we credit the expense accounts and we're going to debit the profit and loss account. For the interest expense, we had 18,000 on the trial balance, and then the interest or the dividend on the preference shares, we had 300,000 preference shares. Each one gets a dividend of 20 cents. That means that dividend is 60,000 Rand. So the total interest expense is 78,000. So there's actually another journal entry here which they haven't asked us to do, but if you were closing off these books yourself, you would be doing a journal entry debiting interest expense and crediting a liability, accrued expenses, for the preference dividend that is still owing. We wouldn't accrue shareholders for dividends, although it won't really matter whether we accrued shareholders for dividends or not, but we are going to show this with other creditors, because if there are any loans that are owing with interest that's owing, we always put that amount that's owing together with trade payables. The next point is that you're going to close off your profit and loss account. The reason we're doing this is because this 180,000 represents now the profit before tax. So the next step is we're going to calculate the taxation amount for the year. So the taxation amount must still be provided for. It's 28%. They're saying the accounting profit and the taxable income are the same. Remember, they also told us 60,000 was paid as provisional tax during the year. So we're going to calculate our income tax amount based on 180,000, which is our profit before tax, times 28%. That's going to give us an income tax expense of 50,400. Again, there's a journal entry here which they're not showing us, where we're going to debit taxation expense with 50,400 and credit current tax payable, and we're going to look at both of those general ledger accounts now. The current tax payable, remember we said there was 60,000 of provisional tax payment. You will see this is a debit balance, because when we made the payments, we would have credited bank, debited current tax payable. So here are the provisional tax payments that I've already made for the year. So if I now look at my income tax expense and current tax payable accounts, here's the 60,000, which is the debit balance on the trial balance, which represents the provisional tax payments we've already made. Here is my accrual for income tax for the current year. I've debited income tax expense and credited the SARS, or the current tax payable account, which is a liability account. So that 60,000 is the provisional tax paid. What happens now is this income tax expense account, we saw this 50,400 went to the debit of the profit and loss account. We credit income tax expense and debit the profit and loss account. That's a closing entry. So this is the profit and loss account, and here's the transfer from the income tax expense account. So in the profit and loss account, these are all closing transfers that have been done from the various expenses and income of the business. So this 50,400 is our tax amount. So if we take 180,000 and we subtract the 50,400, the balance on this account is 129,600. This represents our profit for the year after tax. So that amount is going to go to our retained earnings account, the 129,600. This is also a closing entry. So we are now going to look at the retained earnings account. It has an opening balance of 124,000. That opening balance comes from the trial balance here. That's the accumulated retained earnings up until the beginning of the year. We're going to add to that the profit or loss, which we've transferred from the profit or loss account. This is the profit for the year after tax. We debited the profit or loss account and we credited retained earnings. Here was the debit to the profit and loss account. Now we're going to look at the dividends. There's 50,000 ordinary shares that were issued at R2.50 each, and the issue was recorded correctly. We just need to remember that, because when we do our statement of changes in equity, we're going to have to record the issue of shares during the year. But what we also need to remember is that with ordinary shares, it doesn't matter if shares were issued during the year. We don't have to apportion the dividend that gets paid to ordinary shareholders. Everyone who owns shares on the 28th of February, including these people who bought shares on the 30th of November, are going to receive an 18 cents dividend. And we've already done the dividend on preference shares. Remember, we showed that as interest. So if we look at the trial balance, these 200,000 net no par value shares, this amount of 425,000 includes the issue of shares that was done during the year. So we're going to pay a dividend on 200,000 shares. So we are going to debit the retained earnings with the dividends on ordinary shares amount 36,000, and we will credit shareholders for dividends. In fact, there will be a dividends on ordinary shares account, which we haven't done here. So normally you would first debit the dividends on ordinary shares account and credit shareholders for dividend, and then you clear the dividends on ordinary shares account to retained earnings. That's why we've got dividends on ordinary shares written here. We are showing the retained earnings account, so the opposite side of this is coming from the dividends on ordinary shares account. The dividends on ordinary shares account on the debit side will have shareholders for dividends written, and we will have 36,000 owing to shareholders for dividends as a current liability. This dividend amount is 200,000 at 18 cents per share. So we would have done a journal entry, as I said, where we debited dividends on ordinary shares and credited shareholders for dividends. This entry that you see here now is where we've actually credited the dividends on ordinary shares account and we have debited retained earnings. This shareholders for dividend is the amount that's owing to shareholders for preference shares and is a current liability at the end of the year. Now let's look at the asset replacement reserve. We already did a journal entry for this. Remember, we had to take 15,000 out of retained earnings and credit the asset replacement reserve. That was the journal entry we needed to do, that we saw the debit to retained earnings. All that's left to do with these ledger accounts now is to balance them. So the retained earnings account has a balance of 202,600, which represents accumulated earnings at the end of the year that are still available to be paid out in future as dividends to the shareholders. Please take note now, when you balance the current tax payable account, the debits are bigger than the credits. That means we have prepaid more tax than we needed to pay. 60,000 minus 50,400, it means we've overpaid tax by 9,600 Rand. So this 9,600 Rand is actually going to go as a current asset. It's not a liability. This 9,600 will probably go towards paying the next year's tax then. The tax for the year ended February 2004. But just important to note that it is possible for your payments to actually exceed your liability, and then you'll end up with a prepayment, which is a current asset. Now we're going to look at the statement of profit and loss and other comprehensive income. This statement of profit and loss is actually quite simple because we've already done the profit and loss account. All of these amounts come straight from the trial balance. They also are the amounts, so we put the gross profit into our profit and loss account, and all of these other amounts we had put into the profit and loss account, including the 78,000 for finance costs, which included our dividends on preference shares, and the tax expense is now reflected here. You must please learn the format. It's the same format as you saw for a sole trader, except now you will have expenses classified by function, which means normally you will get distribution costs, admin expenses, and other expenses. There may be one or two other expenses that they give you, but these will be the major expenses that you will see. So companies tend to combine their expenses. In a note to the financial statements, they often give more detail, but this is the only detail they're required to show on the face of the statement of profit and loss. The other thing that's different about the company is that you're going to show your profit and loss before tax, which is your 180,000, and then you're going to show your income tax expense subtracted from the profit and loss before tax to get the profit for the year, which is then your profit after tax, which is 129,600. So here was the profit and loss account where we had the 129,600. You obviously won't always get to do the profit and loss account, but in this question, the profit and loss account basically gives you all of the information that you needed to be able to draw up the first section of the statement of profit or loss. At the bottom of the statement of profit and loss, we are now going to show the revaluation reserve that we created. So if you look at the statement of profit and loss, we're going to have a section here called Other Comprehensive Income. This is standard wording that you need to learn. We are not going to reclassify this item, so you have to say items that will not be reclassified, and we're going to write here revaluation reserve 50,000. Then you also have to learn this wording, income tax applicable to other comprehensive income, and in our examples we're always going to say the income tax effect is 0. So what happens now is that 50,000 gets added to our 129,600. So for the total comprehensive income for the year, we actually have the profit plus this 50,000 revaluation reserve. So the total comprehensive income that this company has made for the year is the combination of the two, 179,600. We are now going to see what this looks like on the statement of changes in equity. Remember, we've said before on the statements of changes in equity, you're going to have columns for all of the equity amounts that are going to go onto your statement of financial position. If we look at the ordinary share capital account, the 425,000 is the balance at the end of the year. We need to show the balance at the beginning of the year, and we also need to show if there were any shares issued during the year. We've already seen this information. We see here there's 425,000. That is the ordinary share capital balance, and this balance we know is at the 28th of February. And we also know this retained earnings was the opening balance, and we know that this 30,000 is the balance before we transferred the asset replacement reserve. And we also know that 50,000 shares were issued at R2.50 each during the year on the 30th of November. So if we go back now and look at the statement of changes in equity, This 425,000 was in the trial balance, this 124,000 for opening retained earnings, and this 30,000 for the asset replacement reserve. You will notice there's a total column here. I really would not spend too much time putting amounts in the total column in a question, because there'll usually be very few marks for that. We might even tell you not to even worry about doing the total column. But basically this total column is adding the 300,000, the 124,000 and the 30,000 together. So we'll see in the ordinary share capital, remember we had the shares that we'd issued during the year, 50,000 shares at R2.50 each. So the 50,000 times 250 means we had shares that we issued of 125,000, and it means that the actual balance of share capital at the beginning of the year was 300,000. So the 300,000 is the 425 minus the 125. We're now going to look at the retained earnings and the asset replacement reserve columns. We've already done the opening balances. We got those from the trial balance. If you look at the retained earnings column, this information is actually going to come straight from the retained earnings account that we've done. We already have worked out the total comprehensive income for the year. This is the retained earnings amount, and we put the revaluation reserve amount separately. So those two amounts together give you the 179,600 that was at the bottom of the statement of profit and loss and other comprehensive income. So the revaluation reserve started off with 0, and we added 50,000 to that during the year. The 129,600 was the profit after tax that we'd worked out. Then we'd also worked out that shareholders were going to get a dividend of 36,000, and we were going to transfer 15,000 out of retained earnings into the asset replacement reserve. That means there's a reduction. This is in a bracket, it's a minus, and that was a debit to retained earnings. So whenever you see something in brackets on the statement of changes in equity, it means it's a debit amount, because everything on the statement of changes in equity normally has a credit balance because it's part of equity. It's effectively an amount owing to the owners. But where you see a bracket, it means it's a debit amount. So this debit of 15,000 went to retained earnings, and the credit went to the asset replacement reserve. Then at the bottom, you've got your final balance of retained earnings and your final balance in the asset replacement reserve, which will be the 30,000 opening balance plus the 15,000 transferred for the year. So we can check those amounts. If you look at your retained earnings account, here's the 202,600, and there's the 15,000 that we deducted from retained earnings and we transferred to the asset replacement reserve. And here's the 50,000 that was put into a revaluation reserve for the year by increasing the value of land. So that amount gets shown separately here. It was also part of comprehensive income. So you'll see here there are two double dots, which means the two amounts underneath it get added together to give you this amount. So the 129,600 is carried up over there, and the 50,000 is carried up over there. So here we have the 129,600 profit, the 50,000 revaluation reserve, giving us the total comprehensive income for the year of 179,600. So we must not add the 129,600 twice in this column. We must also not add it twice there. This is just, there's a block here around this. Sorry, the mouse is making me go very skew. This block is because we're adding those amounts together to give the total at the top. So now we've got totals at the bottom here. These are the totals for all of these equity amounts, and we're actually going to be able to put those straight onto the statement of financial position. So we've already calculated the closing balances that belong on the statement of financial position. Okay, so I've put a block around those balances because we're going to use those balances when we finish now with the statement of financial position. So here's the statement of financial position. These amounts were all on the statement of changes in equity, the share capital, retained earnings. The only thing here is that the asset replacement reserve and the revaluation reserve, the 50,000 is the revaluation, the 45 is the asset replacement. Those two amounts get added together and they're called other components of equity. And we put the total of the two together. So please, that's another thing you need to memorize. This is standard wording that you use, other components of equity, and it's 95,000. So that 722,600 was the final amount in the total column of the statements of changes in equity. So this represents what the business is worth to the owners at the end of the year, including the fact that some of the land was revalued during the year. So the next thing I'm going to look at is just the asset section of the statement of financial position and see where these amounts come from. So we have got property, plant and equipment. Don't be scared by the word financial assets. Because this is a company, we're going to have to use that word, but you're going to see this merely as a fixed deposit, which we're going to call a financial asset. So if it's a company, you call it a financial asset, not a fixed deposit. We also have inventories, trade receivables. Remember, we have a current tax prepaid. We'll show that separately as a prepaid expense. And we have cash and cash equivalents. Remember, the order of what you see under current assets is also important. So if we now look at the trial balance, we can add together the amounts for land, buildings, accumulated depreciation on buildings, and accumulated depreciation on equipment must get deducted. And we must also remember that this amount for land, we must add 50,000 to it. So if you add 50,000 together with all of those amounts, you get 1.294 million, which is the amount for property, plant and equipment on the statement of financial position. Then you'll see here's your financial asset, 50,000, that's the fixed deposit. Here's your inventory amount, 85,000, and your debtors control amount, 46,000. And finally, here's your bank amount, where you had 172,000. And remember, we've already taken account of this current tax payable. That was the prepayment of tax, and we deducted from that the actual tax that was due, which left us with the amount of the tax that was prepaid. It's important that you will have made ticks along the way as you've used amounts in your question to make sure that you haven't forgot anything at the end. Remember, this was the current tax payable amount that I just spoke about. There's the 60,000 from the trial balance, but on the statement of financial position, we actually show the 9,600. Okay, so here's your property, plant and equipment. Remember, that included the 50,000 revaluation amount for land. Here's your fixed deposit, your inventories, trade receivables, tax prepaid, and your cash and cash equivalent amounts. Now we're going to finish off by looking at the liabilities, non-current and current. We do have long-term borrowings, we have redeemable preference shares, we have trade and other payables, we have a current portion of the long-term borrowings, and we have shareholders for dividends. So let's go and check where those amounts come from. So the long-term borrowings, first of all, you will see here I've got an amount of 200,000 and I've taken 50,000 and I've shown that as the current portion. In other words, that's the amount of the long-term borrowing that has to be repaid within the next 12 months. So if I add the 150 and the 50 together, it gives me the 200,000, which is the balance on the trial balance. So if you look on the trial balance, it says their mortgage bond. That basically is another word for the fact that you have a loan on your property, and that loan is owing to the bank, and this is the long-term loan that they've told us is going to get paid off in 4 equal installments. So if I divide this by 4, it gives me 50,000. So the first amount of 50,000 is going to get paid at the end of June 2003. So it's current. The balance that's remaining of 150,000 is therefore not current. The redeemable preference share capital amount here we put under long-term liabilities, because they've told us this is only going to start being repaid in 2008. The creditors' control amount is 38,000, but in the question we also had to add to that the amount for the dividends on the preference shares that still needed to be paid. So you will remember we had shareholders for dividends of 36,000, that was the ordinary shares. And we also had accrued expenses for the dividends on the preference shares. So those two amounts are showing under the current liabilities section of the statement. So this is the end of the statement of financial position. Here we had the long-term portion of the bond and the short-term portion of the bond. The redeemable preference shares are a liability, but they're only getting paid in 5 years' time, so it's a non-current liability. The trade and other payables, this 38,000 was on the trial balance. The 60,000 was the preference dividends. The current portion of the long-term borrowings we've already talked about, and the shareholders for dividends, these are the amounts that are owing for ordinary shares. So we add up the amounts for current liabilities and non-current liabilities, and we put them above the block. So that's the end of the statement of financial position for the company. The only thing that's different about any other statement of financial position that we saw is that the equity section looks different, and we also call the fixed deposit a financial asset. Otherwise, the statement of financial position, everything else is the same as what you've already learned when we did sole traders and partnerships. So this is the end of lecture 4. In lecture 5, the next lecture, we're going to finish chapter 8, and we're also going to do part D of question 8.8.